All right, I guess we'll get started now, man. I want to thank you guys for tuning in to this weekend space. It's a bit of a special space. I know I wanted to get Jack in a bit earlier in the week, but there were some confusions over time scheduling, giving some time zone differences. So I want to thank you guys for tuning in to another segment of Crypto World Radio, presented by myself, Wabi, here on Because Bitcoin Twitter Spaces. And today we're just going to talk shop with Jack. Me and him go way back since like what was it last spring, Jack, when the bear market really started kicking in and the entire like Terra debacle started going down and everything. And you were one of the earlier ones that really called out this downtrend that was going to occur in 2022. And you're honestly a legend, brother. Been following you for a minute. I know Twitter has this weird bug where it unfollows people that you follow sometimes, and that's why my feed gets so messed up sometimes. But it's glad to reconnect with you, brother. How have you been, man? How have you been since the summertime?
Appreciate the kind words. It's been a long year. I kind of feel, well, it's a new year, but it's been a long year. I've been good. Um, the market's been, you know, not not lately, but they've been very slow up until this last uptrend. To me, everything since June has felt like sideways. I mean, there's been movements, but most of it felt sideways. There was not a lot of action and a lot of confusion. Um, so I've spent a lot of time doing other kind of things. Late last year, winter kicked in, and I really had to kind of focus on my mental health. I always have issues when winter kicks in, the short days and that kind of stuff. Um, the slow price action has been welcome in a way to I don't know, focus on exercise and focus on food and make sure that I get outside enough. I do feel kind of good right now. Um, this is my fourth week of no drinking and daily exercise, so kind of feeling fit mentally and physically. Yeah.
Yeah, man, dude, I would not be able to function in these markets if I didn't have anything that pushes me outside of this digital realm, dude. And Um, for myself, I definitely agree with you on doing something physical. For myself, I love doing things like powerlifting, strongman, things of that nature, and it kind of coincides with like the high adrenaline rush of this market class. Um, so I know that you've been in the industry for a minute, man, and especially in the digital asset space. But I'd love to know, how did you come across Bitcoin and all that stuff, brother?
I think it was 2016 when or 2000 early 2017, must have been spring 2017, I'd guess, but it could be 2016. um and I was doing this trip to Newcastle with a friend, and his mom, as kind of like a thank you for her caring for us a lot of times during our childhood. And it was kind of, not, no offense, but it was kind of boring. And he pulled out the white paper of Ethereum. My background is in programming. I'm a software engineer, and I started reading the white paper, and I had a few questions on it, but the concept and the idea kind of really pulled on to me. So basically, I started out as someone who was got into the space through Ethereum. I knew what Bitcoin was um, back in 2012, 2013, but I didn't pay enough attention to it. I think I was too young as well back then to really understand and grasp the necessity and why Bitcoin was so powerful. And I got back home after that little trip to Newcastle, and I started digging and decided to deposit. Back then, that was I think my first deposit was to Bitstamp, but I quickly created an account at Bitfinex, and that kind of started the things rolling. Bought some Bitcoin, immediately swapped it for Ethereum, because back then we didn't really have that, USD markets for Ethereum were, at least as far as I can remember, non-existent. So basically I had to buy Bitcoin and then I had to buy ETH. I think it flash crashed like 40% relatively soon after I bought. So that's kind of um, where I got introduced into everything, and it triggered me so much to go and research everything into it and everything around it, including general, you know, global markets. Um, and that's where it took off.
And I know you're one of the few that sort of look at other markets outside of crypto, like the China stock market, the U.S. equities market. Did you always have that outlook when you were in this market, or did you sort of take crypto as sort of its own asset class where it trades on its own when you first got in, of course? So I know everyone right now, it's like they're not even trading crypto; they're just trading SPX or the Nasdaq, right? And you do have these periods, right? Like over the last month where things just absolutely send versus equities. I'd love to hear your thoughts on that, brother.
I think you cut out there for a second, but like my focus towards regular markets came, I think, later in 2018, 2019, when the Fed had that first tightening cycle into a looser cycle. When they pivoted in, I think it was not 2019 when they pivoted, and that's basically where the echo bubble to from 3 to 14K happened. So that's where I kind of started to dive into what bonds are and equities and what's kind of moving these markets, other currency markets as well, trying to understand um, the role of the dollar, etc. All these things have taken a lot of time, and I'm far from an expert on them, but they're super interesting, and they teach you a lot about how the world works and what makes the world go round. So even a lot of that knowledge is applicable as well in deciding where you want to live, or trying to figure out how cultures are changing or what's pushing and what the incentives are, where the world's going. So it's just general curiosity on my part that tends to also fit into I think it fits into to crypto, because crypto is just a liquidity game, really. Um, so and as Bitcoin grows, um, it's more and more apparent that we're not going to be able to get rid of that influence.
Did you ever get into things like DeFi once like things started to get rolling in 2019 and 2020?
A little bit, but I must say that a part of me was dealing with PTSD from the 2018 bear market, so I was cautious. In my first cycle, I literally rode up a position like 80x and sold it maybe at a 30x. Um, but I was just very, very, very greedy, and it's been that part kept me back after the 2018 bear market to get into that kind of stuff. And then once I figured out it, you know there was some legitimacy to it. I've started to explore why, where those yields were coming from, and I actually quickly learned that those yields were mostly generated through A, FOMO, and B, just generally Ponzinomics, and see that if you would actually look in the market and see how they were generated, like if they were not generated by Ponzinomics, that would just be by trading yields and spreads. Um, so I've done that quite a bit, like algorithmically and manually, by you know, shorting the future curve and longing something else in right now, and then just taking out that spread and basically earning yield myself. But mostly, Um, I let that DeFi thing go past me.
Jack, let me tell you something, man. When you mentioned 2018, all I can remember is all those Neo updates, Wan Chain, and then the promise of this entire interoperability alliance with Icon and Aeon and other things like that. Jack, Jack, you
Dude,
remember, dude? Like people people seem to forget like how insane the volatility can get. I believe right after we hit 19.7, within 2 months we were at like 6K, 7K. And I would say, at least from a drawdown perspective on some of these alts, it's a lot more forgiving compared to 2018. You had ETH going down 96%. 96%. And that leaves you right now, if we were to have that same drawdown, that would put ETH at like 240, 250. And,
mm,
you know,
it's been softer volatility wise. A lot of people in crypto talk about volatility in terms of things moving, but I prefer the term using it. Like when you calculate volatility, you with the formula that TradFi uses, you'll see that actually, when things go down, then that's when volatility goes up. And volatility has been relatively soft outside of the crash to in June. In June, volatility was high, but after that, it's gone. And also leading up to June, that crash. Is that a helicopter? Well, also leading up to that crash, um, it was pretty muted in general. And the thing is, we didn't have that blow off top that we had in 2017 on Bitcoin. I think that matters a lot. So in a way, FTX probably muted the market on that side, and then obviously some returns on the shitcoins this year, this cycle around have been, I would say, more insane than back then. Sam was doing a really good job at creating that ecosystem and pumping everything so insanely high, but he did that at the cost of everyone's pocket. In hindsight.
yeah, what's weird about this top that we had in 2021 is that vol, right? So we're talking about volatility now. The vol for ETH and BTC was a lot more controlled per se versus 2017. Do you think that attributes to or rather, did contribute to the destruction of vol the second half of 2022? Do you think that there's like a correlation between that? Because if the vol was crazy, right, and we had that blow off top in ETH and BTC, and then you look at 2018 where vol was just absolutely insane. Do you think there's a correlation between that, or do you think like do you think otherwise? Because we now have things like DeFi and other things like options and other forms of derivatives.
I think it's partially other forms of derivatives, but it's also the fact that basically by June, the market was already forward looking towards September, where from the most part of the first half of 2022, we were kind of expecting yields to top out around, to stop around September. So peak tightening acceleration was, we were expecting that around September, and obviously that got pushed back by a few meetings and inflation being higher and stickier than expected. So I think that killed a lot of volatility in that part, post the June crash. Um, and people have been anticipating kind of pivot all that year. So at the moment, everything started crashing. We had Luna collapsed, and then all the central lenders, or most of them, because we still have crypto.com, who's alive. At that point, most people thought the worst would be behind us, and then at the end of that story, obviously we had FTX to be like the big boom, the big bang, um, But you want to start buying generally when that list of risks and that, of systemic risk gets reduced. And then if you have a forward-looking market in terms of rates and other kind of stuff that is decelerating its aggressive stance on rate hikes, all that probably played into creating less and less volatility in the market.
Jack, and do you think derivatives are healthy for a market like this? Because even when you go on Binance, right, there are some things that don't even have $1 billion in FTV, but they're traded on perps, right? So essentially, you're trading startups, right? These tokens that barely have the evaluation of a tech startup, and so you'll have these moments where volatility just keeps on getting crushed because you have liquidations on both ends, where there's liquidations on like a 2% move on either side. Do you think moving
Um,
forward that they might have to, like, these exchanges might have to sort of regulate that and focus more on the majors, or do you think it should be more of like a free market where you're free to do any sort of like long or short exposure on these lower caps? I kind of have this idea, this thought exercise that if if a lot of these derivatives exchanges kind of tame their options for users, there can be a possibility where the next cycle will be more spot driven, right? Like 2017 was, instead of derivatives driven like it was in 2020, 2021.
I mean, the upside is that it attracts way more you attract way more capital if there is all these instruments available, because people kind of quote unquote feel safe. For example, you take like if you take a look at Aptos, I'd guess that what we've been seeing lately is early investors getting squeezed. So basically, there was not really much of a market, and there was a lot of things still coming for Aptos, like token generation, and then tokens were generated, and then they started trading, and there was a lot of things that still needed to be decided, and a lot of things that will still have to be built, et cetera, et cetera. So basically, and they launched in a bear market. So I'd assume that these early investors started hedging their investments, and they probably knew when they became an investor that they would get that listing, and knowing that they would feel safer to actually go and make that investment. So in a way, you know, it it allows for very quick capitalization, and going to market very quickly and trying things and experiment things. So I'd argue it's a good it's a good thing that we can do that. But on the other hand, it creates this very predatory environment, which quote unquote new people get exposed to, and they have actually no idea what's going on. And that's, in a way that's fine, because that's their own fault, but you know, that's a difficult ethical question, because the people who've studied these markets more deeply have a better understanding of what their risks are. So a lot of people just get carried out in those kind of situations. But that amount of liquidity being available is making crypto grow faster, I'd assume, at least in terms of capitalization, which I think is a good thing.
And Jack, are you an individual that trades narratives, or are you strictly price action and long vol or short vol?
Mm, Generally, I have like three buckets. So bucket one is, where do I stash my money? Do I want to have dollars, Bitcoin, Ethereum? Um, these are big positions, as you know. There's times where my entire net worth could be in one of those. Um, And that's very macro, very narrative driven. And there's really not a lot of rush. There's position managing, like kind of adding or reducing exposure in that way. Um, and it doesn't necessarily take up a lot of time. It requires just keeping up to date with the metrics that you think are influencing the narrative or are important for the narrative, and then kind of change that around. So basically, I got I got the Bitcoin top wrong. Basically, I was bullish at 65, 69K, and then things turned around. At that point, it becomes technical. You start losing levels, and the narrative is shaping up to confirm that we were going inflationary and rate hikes, et cetera, et cetera. So you kind of flip there. That's the start of a new narrative where it's also the technical start to confirm it. Um, and then the third bucket, so the second bucket is basically just kind of knowing, having smaller positions that may feed into, the big positions. You might add them or remove them. And then the third one, which I've not been doing a lot, is just trading pure technicals on, that could be on a daily, an hourly, or a weekly basis. Most of that is automated on my pod. Um, and the allocation of that is like 10% of my portfolio.
Jack, and speaking on narratives, and I know we touched upon derivatives and all that stuff. Um, what were your initial thoughts, man, when DeFi came to fruition, and then 2 years later you have not only DEXs but also like decentralized options exchanges. We have DYDX, GMX, and then on Ethereum layer two, we have things like the Velix exchange. Did you ever think any of this was possible when you first entered the industry? Because really, back then, like when you got in, right? I got in during late 2017, and during that period. So sorry if there's a lot of noise. It's pretty windy today. Um, During that time period, really the only narrative around Ethereum was this one token that fueled all the ICO craze, right? And the only individuals that were talking about quote unquote decentralized finance was, you know, rest in peace and God bless his soul, John McAfee. You know what I'm saying? So, what were your initial thoughts on DeFi when it first popped up and kind of where we are today?
I used quite a few of the early DEXs. Um, it's been 5 years, I think. So I forgot the names, but what was the
I
first one of the first
I
DEXs
think
again?
I think I think one of them was the Matcha exchange. Remember Zero X Protocol? Um, they wanted to do like the swaps. That's the first thing they wanted to focus on, and then ETH Delta, which worked horribly, absolutely horribly. Oh, IDEX. I'm sorry, not ETH Delta. IDEX. I'm
IDEX, yeah,
sorry.
yeah, IDEX.
Yeah,
That's the
yeah,
one.
yeah. That was an awful experience, man. I remember trying to swap ETH for Icon, and dude, it took over a day, man. The liquidity was so thin, man. And I even remember, you remember Neo? They wanted to do that smart economy, and they had this thing called Switcheo, and it was like this disgusting UI, and the volume wasn't even 100 Neo, dude. So you're talking like, I mean, at that time, you're talking like less than 5 ETH in daily volume, and most of those funds were held by bots.
Hmm. Uh, I mean, I've stuck to centralized exchanges for the most part after after the IDEX kind of exchanges. I felt, you know, if we look at, for example, the whole bridge ecosystem, it was kind of clever, but there's been so many exploits. I think like if you add everything up, we've had what, like 40, 50 billion in exploits on DeFi. So wherever I touched it, it was always in a way where I treated it as a very early stage alpha where all of my money could go poof. And literally, if you add Luna to that, we're talking about more than 100 billion. So I never really felt too compelled to get my hands too dirty there, where I could just trade and do my thing on centralized exchanges. And even that has been questionable lately after the FTX collapse. But um, there's only so many things you can focus on, and over the years I've decided to focus more on developing trading algorithms and focusing on understanding global economics and policies and that kind of stuff, which doesn't make me really good at it, but at least I have some kind of understanding why some of the outside influences on the market kind of move Bitcoin or Ethereum or any of the other shit. So, I'll probably be able to capitalize on that much better next cycle around. Just basically learned from how the general liquidity has caused these insane old flips.
Jack, and what are some things that you usually look at, not only when it comes to like mean reversion plays, but also trend changing algos? Like, do you look at getting some feedback from your brother?
Feedback?
Yeah, yeah.
That's strange.
You're good now. You're good now. I was gonna ask you, since you're talking about building algos and that sort of stuff, what are some of the things that you look at that are indicative of either a mean reversion or more of a trending market on a higher time frame scale?
Most of what I've built is trend following algorithms. So they just build a score for the strength of the bull side and the bear side, and they get into a range where there's not much going on, and they'll start ignoring these indicators. And but when it comes to mean reversion, one of the things that I find very useful is to start finding divergences in flow. So basically, to give an example, right now, I don't know what Bitcoin's price is at currently, but what these algorithms really, try when I'm, trading trend reversions, it's divergence in either flow or general momentum. And for example, if you look right now at Bitcoin, more specifically, if I say it right from the top of my head, Binance Futures, BTC, USDT, you'll see that the flow has changed. So basically, there's more selling on those futures coming into the market, but the market's sideways. Whereas open interest is now going down. So basically, we're seeing people unwinding their positions, their long positions, and taking profit. That's kind of the first signal to look into. And if that divergence goes too big, and then the price action kind of confirms it, that's generally a trigger to get on the on that momentum generating.
Jack,
Is
you
working.
guys able to hear me? Am I good?
Yeah, I can hear you now.
Okay.
I think you were lost there for a second. Um, yeah. So I think some people in the spaces, I know Ahmed for sure. I think a lot of people, including myself, by the way, have this question. Is the bottom in, and what are the scenarios we're going to be playing for going forward from here? So maybe we can jump in a little bit into that, at least before we round up the space later.
Yeah, no problem, man. No problem, dude. Well, as for myself, one thing that I've been vocal about is how 2022 is 2018 part two, right? And you know, our host for our equity show, Carter, I met him about a year ago, and one thing that I was saying is that all we have to do is look at what's happened in prior cycles as far as price action goes. So, a drop off a cliff at the start of the year, right, and then rally towards the spring, make lows in June, run towards the summer, and then mean revert back near the lows in Q3 with a destruction of vol, and followed by a capitulation event in Q4. And right when FTX got hacked, right, and then halted with withdrawals. I know they didn't get quote unquote hacked. They paused withdrawals and then quote unquote got hacked or whatever. Um, I was expecting BTC to go to like 9,000 to 12,000. But the sentiment, as you're describing Twitter Spaces, was so severe that the only data that I could rely on at that point was how that capitulation from 6K to 3K was. And Jack, if you remember, it wasn't even a straight line. That capitulatory event was a process. It was a 4-week process where BTC dropped by 1,000, did nothing, had a complacency bounce, and then dropped by another 1,000 over the course of 4 weeks. But it was just a 2-day dump. It was a 2-day dump, and then alt BTC pairs just like bled out slowly until mid December. So at that point, I thought, all right, it's been well over a year since the top. All of this has happened, and my thesis was, if you start dabbling a little bit, or at least you're starting to be cautiously bullish. And I was very, 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 very vocal that there is a potential for a bottom process to start forming. I was very vocal on that in November, and then come January, right, early January, I was on Spaces and I saw how big they started getting, especially these Web3 type of spaces, these DeFi spaces where you have hundreds of people in them, and it's sort of a side to Twitter Spaces that um, people are just not aware of. If you click the little microphone button on your Twitter app, it opens up sort of like a Google search engine, and it says search up space name or keywords, exactly like a search engine, right? It's sort of like a it's sort of like a search engine that focuses on, like, I guess, these mini type of radio stations, right? So you have the NFT stuff, the metaverse stuff, the DeFi stuff, the macro stuff, and more of the Bitcoin specific stuff, right? And when I started seeing more of these like newer tokens pop up, well, not newer tokens, but newer communities around these new ecosystems, specifically Aptos, I kind of thought like, all right, the price is close to the VC seed, right? The chart is clean. There's no massive overhead supply, because when it got listed, it was pretty much down only after FTX, and Alameda halted their businesses. So they're out of the picture. Who's left? And I'm seeing these spaces from Australia, UK, and all that stuff. And then Bonk started going absolutely crazy. Solana got a shout out from Vitalik and started reversing on a lower time frame. So I started dabbling a bit more, and I do have an undiscretionary bag from Luna V2 at $1, because that's where I accumulated the previous one, and they're building some stuff. And what I'm saying is I started seeing liquidity in some of these, like, obscure alts, and I had to think, when was the last time I saw this? It was late 2018. And if you remember, Jack, right when we hit 3K, we had a massive bounce to like 4,100, right around 4,000 ish, around Christmas. And dude, these alts put in immediate 150, 200% bounces, right? And I'm like, all right,
my thesis might be true. 2022 equals 2018 part two, and 2023, it's going to be 2019 part two. But I thought of it sort of like game theory, how because there are more market participants this time around, it might be front ran, and there's a possibility that it either might get delayed to the second half of 2023, or it might happen a lot quicker in the first half of 2023. So I'm just like, you know what, man? I'm just gonna put some chips on the table, and if this is a bottom, I'll know in a few weeks' time. And when I started seeing, at least at the start of the month, how spot started leading on Huobi and OKX, then I can only look back on 2019, where that's exactly what happened, right? And then on more of like the VC and private round side, there's a lot of money that's been allocating to things like the metaverse, NFT, sort of things, and like new consensus models like blockchain modularity. And we're about 15 months or so from the halving, so I think the probability of us being bottomed out in the cryptocurrency market is a lot greater than not, simply from what we've seen in the past. And I think, Jack, if we were, say, like at the start of 2022, right, and then, someone traveled from the future and told you everything that was going to happen without telling you the price, chances are you would say that BTC would probably be at 6K, 7K with everything that occurred, especially knowing just how tied up the industry was, in things like DeFi, right? And in things like FTX. You did have a lot of projects that were pretty transparent about, like, we do have strong ties to Alameda and FTX, right? But I won't get into FTX and all that. I think that's already been spoken upon way too much, to the point where it's like everyone is some Weenie Hut Jr. reporter thinking they're working for CNBC. Um, but I think if someone were to just tell you how the quote unquote macroeconomic situation was as well, and everything crypto specific that would happen, um, it truly wasn't indicative of the price, right? Like, it's not like, AVAX or Phantom, right, had 99% drawdowns, because even Cardano, right, um, in the 2018 bear market, it retraced, Jack. You remember, 99%. It actually made like an all-time low. It was listed at around 2 cents on Binance, in 2017, and it made a low of a penny and a half in December of 2018. So I think the probability of us being bottomed is a lot greater than not. And one thing that I personally look at, Jack, I look at inflows and outflows, on Ethereum, specifically things like MakerDAO, um, and also Aave. And sometimes I'll look at Uniswap and LooksRare, see how the volumes are there, see how the yields are, see if they're making money in the platform, like through fees and all that stuff versus their token emissions, all that sort of jazz. But when I have not seen a mass exodus from Aave or something like Lido, I forgot to mention that, where the TVL is far greater than its market cap. There's something to be said about that. So until I start seeing a mass exodus, hold on, I see premises here. Jack, until I start seeing mass exodus from Aave or Maker, or people pulling out their LPs from Uniswap, or 1inch, or say like Arbitrum and Optimism start having their TVL drained, until I start seeing signs like that, then I'm not going to think that Ethereum's going to hit a new all-time low, because there's a ton of liquidations on chain, at about like $820, price on Ethereum. And if you have a cascade like that, then we can hit 500. But it's sort of like what happened with Anchor, Jack, where you did have a few days in advance where you're like, wow, what is going on here? Why are there people withdrawing their LPs from the Teradexes? Why are there people withdrawing from Anchor, right? So you do have signs that tell you in advance. And for me, I'm sort of like left curving it, mid witting it, whatever you want to call it. And I find it a lot easier on my mind. And let me tell you something, Jack. I don't want to ramble here, so I'll let you go after I finish this statement. But for me, I'd rather just make a few associates that can give me the TLDR on the macro stuff instead of, trying to learn a whole new market when I'm doing a multitude of things, you know. And as you know, balance is very important in a market like this. You do need to do things outside of, making your own models, looking at charts, looking at narratives. And for me, I'm more of a fundamental guy. So when I look at things and it's like, wow, these things are down over 90, 95%. You know what I'm saying? We went through all of these things and BTC, still maintained 16, 17K. Because we were barely at 15K, guys. And one thing that a
Mm.
good friend of mine, his name is Zuzi, I see him down here in the crowd. He told me that, we were reaching a point where you had these mining companies like Marathon and HUD 8 have their margin calls under 15K. And if that were to happen, Jack, let me tell you something, brother. There would have been a straight line straight down to 10K, 9K. And at that point, miners would be at a 50% in the red because the current break even price to mine one BTC on average is about 18K or so. And at that point, when you're like 50% deep in the red, that is a loss of confidence. That is a loss of confidence, right? So it was either, this time is not different or this time is different and it's not good. It is not good. So with that being said, those are kind of my thoughts and the things that I've been looking at. What about yourself, brother?
Think a lot of, oh, shit, that was my phone. I think it makes a lot of sense what you're saying. Like structurally, when you look at you know, um, for example, purely Bitcoin, your assumption here has to be that we bottomed out. Like the structure and everything that went into that structure, like events and etc. They um, they give you everything that you would need for a bear market bottom. Basically, the sideways range, which could have been, well, in hindsight, if that was the bottom, was an accumulation range, and then you had like your final blowdown with FTX, and basically all the risks exiting the market, and then you obviously had the whole sentiment around the macro being incredibly bearish, and we've got. So basically, what I'd say is that I say it's 60-40 right now. 60% bear market is in, 40% bear market is not over. And to me, that was 30-70 when we started to break down when FTX happened. I thought things would be worse, become worse after that. And like you said, there was a lot of liquidation risk below 15K. And it's funny because we got to the point where, and this is where the risk, I'm 60-40, so obviously there's 40% that still accounts for a bunch of risks. And when you look at the recession trade, which was kind of consensus throughout 2022, if you look at risk premia in the bond market, in equities and that kind of stuff, they're basically gone. You're buying 5% puts, so 5% out of the money puts right now, is the lowest. They have the lowest price in, I think, 2 or 3 years. So essentially, the market is no longer really hedging, and we're full force into this new trend. And then, so to put it mildly, the recession trade is now very contrarian, and also based on how the market is pricing, unlikely. So if it rears its head again, it's going to get very ugly. But for now, we have to assume that's not going to be the case. So we have to look at the metrics that kind of confirm whether that's going to come back or not. The one thing that I have difficulty with in comparing this to the rally we saw in 2019 is the differences in monetary policy, because back then the Fed actually did stop the quantitative tightening, and they started to buy bonds again, which we currently don't have, and it looks like they're not going to do that for the foreseeable future unless something kind of breaks. And then the other risk, so basically that's one risk, somehow recession trade comes back in play. So that's part of the 40%. And the other part of that is, let's see, I just had it on the top of my head. Yeah, so basically the other thing, and also currently not looking very likely, but you never know, because we don't know what's going to happen in the future, but is that the inflation trade is kind of getting fucked up. So right now we're expecting that inflation is going to fall off a cliff, and it's literally doing that. We're seeing it's what it's been doing for the last couple of months. December saw a retraction, and actually negative CPI month over month by 0.1%. And so the question is that an outlier? And are commodities kind of bottoming here? For January, we were looking at 0.58%. So if you extrapolate 0.58% to an annualized number, that's 7.2% inflation. And if that's the number we're going to run, like the 0.58% month over month inflation, we're going to get 6.4% year over year. So basically, that would mean that the decrease in inflation we've been seeing for the last couple of months is kind of flatlining. So the risk there is that we're starting a new inflation trend, which kind of puts the Fed in a position where they're going to have to continue hiking for longer, which may actually cause this kind of Goldilocks moment that we're seeing right now to kind of get shaky and kind of see some panic back into the market. And so that's the other part of the 40%. And if you really zoom out, there's a whole bunch of reasons that could make or break this. And my biggest question is, the Fed is going to pause, this year. And if inflation if inflation can get below 5.5%, I'm pretty sure the Fed is going to declare victory. So as long as they don't get there, we're going to have these tiny increases. And the question is, where does from this point on? Well, I think S&P 500 is at like 4,100. It puts you in a question like financial conditions have eased back to levels seen in February. So, my biggest fear for my 60% conviction that the bear market bottom is in is that inflation is going to rear its head again in the coming months. And we can keep going up in that kind of market environment. If people want to buy, and they're going to be buying, and then recession comes and then we put in a higher high, basically. And I think that very much depends on the timeline. If things turn sour, if we got too bullish too quickly in BTC, ETH, but also global markets, that would be ugly. But for now, I think you need to follow the trend. We can kind of have this breakout on the S&P 500 along the trend line that's kind of defined 2022. And you got to long that shit. and if there's pullbacks, get long. And if it turns out to be wrong, which is entirely possible, we either hope that we're going to see the signals ahead of time, and if not, it's just going to mean that we're going to have to take a loss on those positions, which unfortunately is part of the trade. But you kind of know that when everyone got uber bullish and it turns around too much, too far, that you're going to have plenty of legs to the downside to kind of make up for that loss. So basically, from where I stand right now, is if you look at BTC, you don't want to see that thing retrace more than half of the move it's made right now, or wherever this move ends up. Maybe 61.8%. But that's kind of where, if this market really is bullish, and the bottom really is in, where you want to see people aggressively buying if there's some kind of sudden negative event that everyone freaks out again. So that's kind of, if that doesn't work out, then we get stopped out and we cry and we'll go lower. But for now, the 60% is mostly convincing to me.
Premise, if you want to comment on that, feel free to go ahead. I know you had requested to come back up, and we're just shy of reaching the hour mark. So if anyone here in the audience wants to give their statements to myself or Jack, or come up with any questions, feel free to do so. Click that request button, and I'll bring you right up. And just as a reminder, if you just came into the space or you've been in and out of the space, a replay will be uploaded onto our YouTube channel in about 5 to 10 minutes after the space is concluded. And just as a reminder, we're here with, can I call you Jack Sparrow, brother? Is that okay?
Yeah, Jack is fine.
So, Premise, go ahead, brother.
Yeah, I was actually gonna say I agree with that 618 Fibonacci retracement. When I draw one from the very bottom of that dip, the very low we made on this whole run to the top of where we just ran to, what was it, 23,816? The 0.618 is right at that reclaim level I like. It's around 18.3. And I wouldn't be surprised if it went that deep. I want to see it hold higher, but I kind of agree with Jack that that's the level you want to hold. Beneath that level, I told everyone I would be bearish again. So I actually agreed with him spot on with that. I just came up since y'all were talking crypto, and I'm loving the crypto space and stuff, and trying to see if y'all had any little cheeky plays. Not saying you're shilling them, or what should I be focused on? Is it AI? Is it stuff like what Flare Token's trying to do, bring smart contracts to Bitcoin? What's the cheeky play that I can get in on if this is the next run? It doesn't have to be the run. We saw in 2018, 2019, different alts did crazy runs while Bitcoin ranged from what 3K to 12K twice, and then it went down on 4K, never made a lower low. So I'm not too sure. Like, we don't want to call like, hey, the lows are in, etc. But that there's clearly some attention into the market, which means there's money to be made. Just trying to figure out what's my edge here.
Well, I think one narrative that hasn't gotten a lot of traction yet, but I think will get necessary traction. I don't know. I think this cycle, but maybe the cycle after is actual infrastructure, basically cloud, like block space in where block space meets cloud infrastructure, where you can organize around decentralized organizations in a blockchain that lives in a decentralized cloud. There's several projects working on it. For like, if you look at how costly Ethereum block space is right now, and the fact that a lot of the data is being archived in kind of centralized companies like Consensus and Infura and that kind of stuff, that requires another layer of innovation. And I think you need to really bring together like the Web2 infrastructure, like AWS, but not able to AWS, but a protocol that allows cloud companies to get into the protocol and provide trust minimized compute. So there's going to be some overhead, but you're not going to like replicate all the computations across all peers like Bitcoin kind of does. But let's say you can compete at a 2x cost basis to AWS, and then create all these different DAOs that act as miners slash cloud providers slash cloud companies that specialize onto different branches of interesting cloud necessities. I think that's something that will become really important to actually decentralize both, you know, DEXs, because a lot of DEXs still run run a lot of their storage on centralized infra, and a lot of data can just disappear if the centralized parties that kind of store it. So you have your hash, cool. It tells you that's yours, but is the data still there? I think that's going to be important into the next cycle to actually mature this space.
All right, we have one more question from Beta Meta Group. Then after that, we'll start wrapping up the space.
Awesome. Thanks, guys. Jack, really quickly for you. So what really got me excited about Bitcoin originally was once I started reading that paper from Square and ARK Invest talking about Bitcoin as the key to a clean, abundant energy future. I know there's a lot of confusion around Bitcoin's energy use and how it's beneficial or detrimental to the future of really, really robust energy grids. Do you have any ideas or methods, or how do you talk to people about Bitcoin's energy usage to make sure that we're constructing the narrative in a way that is positive and enlightens people about how it has all of these good beneficial aspects in building more robust grid infrastructure?
I think for me, it starts out with the notion that Bitcoin subsidizes energy innovation, and that energy usage in itself is not the main narrative why that's bad. It's not bad. People think about energy usage as being bad, but it really, at the end of the day, isn't for the people who criticize Bitcoin's energy usage. These I was actually having a conversation about this just a week ago with someone, but so basically, as Bitcoin is subsidizing energy innovation, the block rewards kind of give us this little extra chip that miners can use to go and explore ways of balancing networks and utilizing energy that's stranded, and also plug into existing edges of the infrastructure where we kind of store energy or give energy back. I think at the end of the day, people need to understand that that's a net positive on the grid, and in a free market, people kind of they decide they want to run their laptops or their iPads, and we decide that we want to use Bitcoin because we think that has value to us. So there is no, in my opinion, there should be put no limit on how much energy you use and how you use it. But what you could do is, for example, say, okay, well, we don't want bad energy to be used. We don't want to have coal mines powering anything. If coal mines are used to power Bitcoin, all of a sudden it's bad. But people are using coal mines every day to power their fucking laptops and all that kind of bullshit. And these miners, they actually use that money and go elsewhere and figure out ways to produce energy and utilize energy that's clean. We're the cleanest business around. So it's a tough topic, and I always kind of fail to really bring that across to people. But I think the main point is that, if Bitcoin is, for example, 65% renewable, is that, that's a good thing. It shows how other industries can actually become greener. It's setting an example of how you can transform your business and your industry to a greener state. So if anything, Bitcoin is rewarding people to actually make that energy transition and make sure that we produce less CO2, if that's really such an issue in the first place.
All right. With that being said, Jack, on behalf of myself and Because Bitcoin, we want to thank you for taking the time out of your weekend to coming up and talking some shop, man. It was good catching up with you. And if you guys enjoy content like this on a more crypto specific level, feel free to follow us here at Because Bitcoin here on our Twitter page. And about 5 to 10 minutes after the space is concluded, it'll be uploaded onto our YouTube where you can hear the entire replay. Jack, thank you so much, man. Thank you. Thank you. It was great catching up with you, brother.
Likewise, man. I'm gonna head to my bed in an hour, and we'll talk again tomorrow.
Yeah, man, kill it, bro. Kill it, man. I hope you hit a PR pretty soon, man, in the gym, brother. I know after this space, man, I'm heading straight to the weights, man. I'm gonna do some lower body, do some squats, do some farmer's walks, some yoke runs, and probably some leg press and some back stuff as well. So hope you rest up, brother. It was good catching up with you. And with that being said, everyone, feel free to join our Discord up above. We have about 1,200 members. It's completely free, and it's pretty much 24/7. Members from all across the globe trading all markets, commodities, equities, crypto, NFTs, you name it. Feel free to do so. It's up above on the Nest. And yeah, we want to thank everyone here for tuning in to a weekend special sort of space. I know we usually run these spaces Monday through Friday, but Jack hit me up and he's like, "Hey, man, let me make up for it." I know there was sort of a scheduling conflict, and that's the thing with these these time zone differences, and that's why I always encourage you guys that when you follow the Because Bitcoin page, always turn on bell notifications, because sometimes when it comes to our crypto specific side of content here on Crypto World Radio, we will have guests that oftentimes are in complete different time zones, so it might be a little bit earlier than 7 p.m. Eastern or a little bit later, and on this rare occasion, sometimes on a weekend, and we'll see if that's a bit easier on our guests if they want to come on weekends or something. But anyways, I'm gonna go train. Thank you guys so much for supporting the Because Bitcoin brand and for showing up on a weekend. With that being said, thank you all so much. Feel free to leave any comments on our YouTube channel and also subscribe to it so you can, be up to date on all of our content when it gets re-uploaded, given that we will be pushing very hard here on Twitter Spaces with all of our 3 content streams. And thank you for everything, guys. Take care, and God bless you all.
The trading current is just math. It's just math. It has a 95.45% hit rate when we deviate outside of CP2 and CN2. All you had to do is recognize that 95% of the time when we get over here, under this blue line, we get some sort of mean reversion. So let's just assume you long right here. 95 out of 100 times, when I buy this, I'm gonna get some sort of bounce. It's just math. Look what would have happened as we move up. Look at the bounce that came after. And now look where we are. If you had just blindly followed the current, you take all emotions out of it, and you say, I'm going to trust the statisticians, you would have bought Dow Jones somewhere down here under 30,000. You know, depending on how you want to measure it from absolute top to bottom, 20% move. We also have multi-time frame alerts. You don't even have to be at your computer on TradingView. It can ping your phone. Now, the current has some really awesome features, and I would urge you guys to join our Discord to get access to it. We give it away for free as a tool to the community. It's just math. There's really no need to overcomplicate things, not even in the slightest.